Glad you're with us. This is the Retirement Education Hour. I'm Megan Mozak, back in the studio today with financial instructors Kirk Cassidy and Dr. Paul Metler. We have a great program lined up for you today. Throughout our show, you're also going to be hearing about how you can attend the Retirement Education Foundation's courses on retirement. These are like master's level courses. And if you're thinking about retiring soon, or maybe you've recently retired, you owe it yourself to be there. In fact, we want to see you in the front row. You can find out much more at the website. That's how you get registered. Go to retirementplanningedu.org. Now, a lot of people out there, including me, I always thought that asset allocation, when you're thinking about retirement, that this is just choosing a percentage of stocks and bonds, right, based on when I want to retire. But this is actually a lot different. Asset allocation, when we're talking about retirement, Kirk and Paul, what you've been telling me is that this is all about timing. In fact, the timing of your money matters more than all of those percentage of stocks and bonds. And I'm excited about this episode. I want to dive in with you today about how something called sequence of returns risk, and we hear that phrase a lot, and income timing, and then, of course, our portfolio structure, how all those things influence just how successful or unsuccessful our retirement is. It's all kind of wrapped up in this, isn't it?
It is, Megan. I think this is where where we see it, right? Remember, we're a national charity. We've taught tens of thousands of people. We have hundreds of thousands of people consuming our content. So we get the opportunity to meet a lot of people when we teach our 8-hour, what is like master's level courses. And so what we see in this cohort of that 1 to 10, $1 to $15 million family is often people who they've done obviously very well saving money, investing their money. They believe what's going to drive success in retirement is what they invest in. They don't in probably people are listening saying, duh, of course that's what's going to drive success. And it's not. That what you invest in is probably the easiest part of building a retirement plan. It's not what technically will drive performance, because you have a variable once you retire that's different than when you were accumulating your wealth. You're beginning to take distributions out of your investments. You're going to take money out of your accounts. So when you take money out of your accounts, you're going to have to sell some of your investments. And so when you take money from which accounts during different market conditions is going to drive your performance. So, and I get it. Listen, asset allocation, if for those who are really technical and want to be more advanced and talk about, what percentage we're putting in large, mid, small, value, growth, blend, international, that's a rabbit hole we could really dig into. But I want to focus on what's really going to drive success today and how you should be investing. And so I think, Paul, one of the challenges we have is people are using general rules of thumb to choose as they approach retirement. And this is the caveat. We're going to talk about younger people in a minute, but if you're within 5 to 10 years of retirement through retirement, they're using rules of thumb to drive their asset allocation and what they invest in, as opposed to what do I need to give me what I want? In other words, goal-oriented investing.
Yeah, I mean, we tend to be, people who listen to us often know this. We tend to be a little anti-establishment. Maybe one could argue, I don't know, but I think today we're going to blow up a little bit of the establishment, because there are so many generic rules around asset allocation as we age. There's actually funds that are based on these generic rules, life cycle funds or rules of 100, or there's all these generic rules of how you should allocate your assets as you age. And to be honest, they're useless. And we're going to blow them up today. And I'm excited to do this.
It's great, Paul. I'm so funny you said life cycle or the target dated funds, which is just not an efficient, effective way to approach retirement. It's really not for that 1 to 15 million. It's for more entry level investors. But listen, I think if you listen to our show today, we're going to really change your perspective on what's going to drive success in retirement. And if you attend one of our 8-hour master's level content courses taught at major universities, we will significantly change your retirement. So attend one of our 8-hour courses taught at major universities in your area. If you'd like to register, go to retirementplanningedu.org. That's retirementplanningedu.org.
I love this topic. And the reason being is because we meet so many people who have these ideas about what's going to drive success. And it's so hard to help people understand that, most people think they got to pick, if they pick the right stocks over their lifetime, that's how they're going to make their money. And that may be true during the accumulation phase. You can argue that or not argue that. But in the distribution phase, it's really hard to convince people that has nothing to do with the stocks you pick. If your asset allocation is the way it should be, and we're going to talk about how it should be. If you have a good asset allocation model, eh, over your lifetime, you will blow away somebody who picks stocks. You're going to blow away somebody who's trying to time the market, right? People think that, asset allocation is pretty simple. As I get older, I should just have more bonds, right? If I'm, 70 years old, 30% of my money should be in equities and 70% should be bonds, regardless of when I'm spending money, where I'm spending money, how I'm spending money. And that's such a useless rule. It's such a useless idea. I mean, why does it continually gain momentum? I don't.
Well, it's cookie cutter,
Yeah.
it's simple, and it's scalable. In our industry, people want things that are easy to do. As a business owner in the financial service industry, they're there to be profitable and make money. And if they can have a general rule of thumb that's scalable, it's much more profitable. Paul, here's the problem. I'm less worried about the industry in this moment right now because, listen, anyone that's listened to our shows or come to our classes, that's what we're going to help you choose is the right teams to hire. We spend an hour of the 8 hours going through how do they get paid, what specific questions to ask. It's those 1 to 10 million overconfident people who have been really good at investing and saving, or they think they've been good at investing and saving. But they really don't understand that, and we're going to talk about it today. When you spend your money will determine, when you're spending dollars from whatever account you're spending, will determine how those dollars should be invested. And when the market is up, where you're pulling your money from versus when the market is down, where you're pulling your money from is going to drive the real returns of your portfolio and drive success. If you're able to manage this and do it properly, now you can have 7, 8, 9% withdrawal rates per year as opposed to the rule of thumb of 4%. So stick around. And we also encourage you to attend one of our 8-hour courses taught at major universities. Again, we're a national charity. We ask for a $29 donation to charity. If you'd like to register, go to retirementplanningedu.org. That's retirementplanningedu.org. Thanks for listening to the Retirement Education Hour. Be sure to follow or subscribe when listening on Spotify, Apple Podcasts, or wherever you listen to your podcasts. And now back to the show.
Let's talk how we have to shift things when it comes from accumulation to distribution. What's the difference here?
Yeah, Megan, anyone who's listening to our show, listen to lots of radio shows and TV shows or doing research around this, has heard this expression by people in the financial service industry for years, the accumulation versus the distribution phase. I think you guys get it. The accumulation phase is when you're younger and you're accumulating wealth. We actually like to describe this as a phase of your life where money has a lot of power over you. So you're going through the accumulation phase, you're serving money for yourselves, your family, raise your family, maybe put your children through school, you're saving for retirement. At some point, by the way, the accumulation phase, to be clear, is not hard. And I'm going to offend some people, and that's okay. I'm not here for people to like me. I'm here for people to want to come to the charity's educational courses. So there isn't very many people that have done the accumulation phase particularly well. There's not, most professionals don't do the accumulation phase well. It's really not difficult. People overcomplicate this. All you really needed to do is buy the S&P 500, the index, and a little international. And I can promise you, over the last 30 years, you had a better outcome if you did that versus than what you had done. What you were good at, by the way, is being disciplined, serving money, letting money have power over you, making good disciplined decisions and saving and putting yourself in a position to succeed. But it wasn't the investing. But we digress. That is when you're young, really investing isn't that difficult. Then you enter the distribution phase. So now this is a phase where you are beginning to take distributions, money out of your portfolio to live on in retirement. And by the way, you should. This is the phase where you have to find a way to take power over your money. And I know you guys are listening and saying that's a bit corny. I'm telling you, this is one of the most difficult things for people to do as they retire and in retirement is taking power over their money. We give you so many examples in the class. I could, in 2 seconds, give you an example in your lives where, for example, here, ready? Here's power over money having power over you. Many of you don't have your estate planning documents, your powers of attorney, healthcare powers of attorney, your trusts. You don't have any of that stuff done because you don't want to spend the $3,000 to $5,000 to have a professional to do it. Or you've gotten your free legal service through your employers. You haven't done it because you didn't want to spend the money. And I then need to ask you, if you're retired, how much less income per year will you spend if you spent $5,000 on a really comprehensive retirement trust, a revocable living trust? Tell me, how much less? You can't quantify it. It means your kids get $5,000 less. That is an example of power over money, money having power over you. And so in the distribution phase, it is how do I gain control over my money? And that is through education, risk mitigation, and having a truly comprehensive retirement plan. And once you have a truly comprehensive retirement plan that's telling you where you're spending your money from at different ages, now you can do proper asset allocation because that's what's going to drive success. Where am I taking my money? And we're going to explain why that's so important in the next segment.
Kirk,
I know I was a little all
no,
over
it's
the
okay.
place tonight.
You're talking. I'm thinking at some point we need to do a show just on how people transition from these two, from accumulation to distribution, because we talk about it as if it's, a light switch, right?
No.
It's if we turn the switch and you automatically do this. It reminds me, I don't have the time to get into. I recently met some from in a class who single, no children, legacy wasn't important at all. And his first statement was to me, he just wanted to keep seeing his net worth grow. And I said to him, is your goal to be the wealthiest person in the graveyard? Right? Is that your goal? The problem was he never was able to psychologically, let alone financially, transition from the accumulation phase to the distribution, because it's not an easy thing to do. It's a hard transition to make. And so one day we should do a show on it. But the one thing I will say to you is this. I think people believe that in their retirement, if they, allocate as they've been told to allocate, accumulation doesn't matter. You can still grow your money in
For
retirement. You can still see growth in your retirement. The key is how you do the allocation. And we're going to talk about that.
I think that's a really good point, and I'll give some really interesting statistics. Paul, you ask why he feels that way because he has been conditioned, taught by our industry to feel that way, to be afraid of outliving your money, worry about inflation in retirement, protecting your principal. You'll spend less in retirement. That's not true for most of you $1 to $20 million people. You're going to spend more in retirement, not less once you retire. Only 18% of retirees actually spend money out of their savings. It's crazy. 80% of you will die with the same amount of wealth that you had the day you retired. Let us teach you how to spend money and build a plan. Come to the charities courses. They're 8-hour master's level content taught in universities, taught by a national charity. Go to retirementplanningedu.org. That's retirementplanningedu.org.
Listening from outside Michigan or Missouri? We stream courses live from the university so you can attend anywhere in the country. Go to retirementplanningedu.org. That's retirementplanningedu.org to sign up. And now back to the show.
I do want to talk about our income timing, right? How we're invested, and do we need to be invested differently as we get closer to that retirement date? How do we look at income timing when it comes to this allocation we're talking about today?
Okay, so Megan, once we're in our distribution phase, I would actually, we argue, and we teach this in the class, that once you're within 5 to 10 years of retirement, we have to set our ego aside. I think, at the end of last segment, Paul mentioned about someone that came to a class and didn't have children, didn't have legacy. I think, was he single, Paul?
Single, never
Single,
been married.
never been married. And I don't know where his money was going when he was going to die, but all he was concerned with is growing his portfolio, right? In that ego, for some people it's ego, some people it's fear and anxiety. There's a lot of different variables, but we got to set the emotion and ego aside, and math needs to drive all of these decisions. And very, very, very few people, or very few people in the financial service industry, are truly allowing math to drive these decisions. And the problem is, when I say that, many of you listening and many people in our industry think, no, we're using software, we're using math, we're using spreadsheets. But you guys aren't doing the right math. And so it starts by understanding that how your portfolio should be invested and allocated should be driven by when specific dollars in your retirement plan are being spent. Like, first, you have to run hundreds of iterations and scenarios. For example, in our class, we show you what takes 50 hours to build a plan, because we're running hundreds and hundreds of scenarios, testing many different strategies, timing sequences, risk variables to optimize income or performance legacy, whichever is important to someone, to mitigate the risk of outliving our money, early spousal death, tax traps, long-term care. You're going to have 6 to 8 major market events throughout your retirement, and then to pay the least amount of taxes over your lifetime. So a full lifetime tax. So running those iterations in those scenarios, and once you've constructed a plan and you know what dollars are being spent when, now you can do an asset allocation, because you can never take money out of a portfolio that is down, ever, ever. You are locking in those losses, compounding those losses, and will destroy your real return and your performance. If you don't manage this single event, which is called sequence of returns risk, we're going to talk about it next segment. If you don't manage that, then you can only take 3 to 4% withdrawal rates in retirement. But if you manage this sequence of returns risk, you can now have 7, 8, 9% withdrawal rates. You're going to drive the greatest real returns, because you've mapped out when you are going to spend money from your different accounts. And based upon if the market's up, you're pulling money from these accounts. If the market is down, we're pulling money from these accounts. To do that, as you can imagine, you have to have asset allocation with non-correlated investments and portfolios or accounts that you can withdraw from, no matter what the market is doing around you. You can't allow the noise to impact you. You have to take the income strategically based upon. So what we're saying, Paul, essentially is we don't time the markets. You don't want to time the markets. No one can do that. From an investment perspective, we time income based upon market conditions.
Yeah, I keep going back to this person. I'm sorry that I met in the class, and it's in some ways counterintuitive what we're saying. What I try to say to this person is, listen, if growth really matters to you, okay, that's fine. If your ego is involved here and you just want to die being a multimillionaire, fine. But if growth really matters, then your asset allocation is hugely important. What's counterintuitive is that he had everything in equities. And the thought that maybe he would have a portfolio that wasn't, hitting a home run didn't make any sense at all. What I try to explain to him is, if your asset allocation mimics the timing of when you take your income over your lifetime, you're going to end up having much more growth.
Yeah, no,
right?
That's real returns.
That's real returns. And people don't understand that's counterintuitive.
Yeah.
It's hard to convince people of this. But really, as long as you are not taking income, taking money from an account that's going down in value over your lifetime, you're going to be way more successful than those people who are just drawing from any account they want and taking huge risks.
If people don't come to the class, they don't believe us. But I'm going to say something, and we're going to talk about it next segment, sequence of returns risk. But I'm telling you, go to our charity's website. We actually walk through this in sequence of returns risk as well. But we'll show you in the class a person with an average rate of return of over 10% over 20 years. They've had an over 10% average rate of return and they ran out of money in 17 years by only taking withdrawals of 5% a year. Real returns is driven by where you're taking your income from when the market's up versus the market's down. We'll talk about it next segment. But again, it's an 8-hour class. It's master's level content. This will change your retirement. Our charity's been doing this for a decade and a half. We invite you to attend one of our 8-hour classes taught at major universities. Go to retirementplanningedu.org. That's retirementplanningedu.org.
Classes are forming now. Go to retirementplanningedu.org to register. Again, that's retirementplanningedu.org. Use the promo code PODCAST to receive 50% off your tuition. And now, back to the show.
You know, Kirk and Paul, at the top of the show, I mentioned a phrase that we hear all the time, and it gets kind of thrown out a lot, but I'm hoping we can go a little deeper here with the two of you. Sequence of returns risk. Let's define it, and then let's talk about how it matters to this conversation.
So sequence of returns risk is the number one risk to all of your retirements. And it has been for decades. Academia has been talking about this for decades. It is just recently picking up traction. It's super interesting. You know, our charity's been around for over 15 years. We've taught tens of thousands, hundreds of thousands are consuming our content. And it's fascinating how much the financial service industry, the marketing side of the financial service industry is a copycat industry, Paul. This sequence of returns topic is something that we have focused on for 15 years. We've done white papers, we've done webinars, we've done interactive calculators. Fascinating. The number one downloaded white paper is sequence of returns risk. And what we have found is that almost 70% of the people downloading that white paper are people in the financial service industry. So now everyone's now talking about sequence of returns risk, which is great. I want the consumer to understand. We have gone even further now in our education, teaching people the mechanics of sequence of returns risk, not just what it is, so that they can prevent people in the financial service industry from manipulating and say, hey, yes, we manage sequence of returns risk. You need to understand and be able to identify if someone is really managing it. So that's what we teach in the class. Because look, sequence of returns risk is what's going to drive your real returns, performance. Managing that risk is what drives performance. If you effectively manage that risk, you can actually take 7, 8, 9% withdrawal rates. If you don't manage this, you're going to have to use the 3 or 4% rule, which my guess is most people out there are using the 3 or 4% rule. And that tells me, and I know most people in the financial service industry providing services is not truly managing sequence of returns risk, because it is really, here's why. You can have two people, Paul, with the same exact performance over a 20-year period of time, with a 10% average rate of return, two different portfolios, two different people. They both are taking out 5% a year to live on. So they're both retired with the same average rate of return of over 10%. One will have $2.8 million because they started with $1 million. They had $2.8 million 20 years later. The other one runs out of money in 17 years. They had the same average rate of returns. The key is, when the market is down or your portfolio is down, you can never sell anything and take a withdrawal from that portfolio, because you will have locked in the losses. You will have sold. And when that portfolio recovers, it has fewer shares to recover. You've compounded those losses. So everyone here listening knows if you lose 50% in 1 year, you need 100% to break even the next year, right? So think of it. Your portfolio is down 25% and you take out 5% to live on that year. You need over 40% the next year to break even, actually close to 50%, because you need 5% again to live on. I know there's a lot of numbers. I know it's overwhelming. Here's the deal. Here's how I know most people aren't managing this, those that are doing it themselves and those who have professional help, is because on average since 1980, the market experiences a 14% drawdown per month. Per year. Sorry. Let me start over. A lot of numbers. On average, since 1980, the S&P 500 experiences a 14% loss at some point within the year, an intra-year drawdown of 14%. 78% of the time, the S&P 500 will have a positive return at the end of the year. So when the market's down 14% on average per year at some point, where are you taking your distributions from? You have to have appropriate accounts to take that money from when your portfolios are down. Then, Paul, and I'm going to take the segment, sorry. Then, Paul, in our next segment, we're going to talk about what about a sustained market downturn, which is really impactful from a sequence of returns risk. If we have a longer period of time before the portfolios to recover, because you can never sell or rebalance a portfolio if your portfolio is down. You have to have a different account to take your income from, and you have to wait for that portfolio to recover before you rebalance and then begin drawing from it. That's going to require something called a pivot account, which is, I think, the most critical piece to a retirement plan to drive real returns, which we'll talk about next segment. I know it's a lot. I gave you a lot of statistics, a lot of numbers. It's pretty technical. This is why it's 8 hours. This is why it's master's level content. I cannot stress the impact this course will have on your retirements, helping you avoid so many mistakes and providing you the confidence to choose the right teams in retirement so you can spend 7, 8, 9% per year in retirement to enjoy your retirement. So attend one of our 8-hour courses taught at major universities. We ask for a $29 donation that goes to charity. To attend, register at retirementplanningedu.org. That's retirementplanningedu.org.
To find our latest white papers and webinars, go to retirementplanningedu.org. That's retirementplanningedu.org. And remember to subscribe or follow wherever you listen to your podcasts. And now back to the show.
There's, been a lot of talk about volatility and what the market could be doing long term. Would we see a market downturn? I'm excited to hear about pivot accounts because it sounds like this could be an important key element for retirees who are worried about that.
This is probably the most important account in your asset allocation for your retirement plan. And if you stick around for the last segment, we'll talk more specifically what a plan is versus what a plan isn't. But once you have a comprehensive, fully iterated retirement plan, and if it's done properly, you've got CFPs, CPAs, attorneys, wealth managers spending 50 plus hours running hundreds of scenarios to optimize, risk mitigate, minimize taxes, building a plan. In that plan, part of your asset allocation must be to what we describe as a pivot account. You may never heard of this before. To make it simple, it's a negatively correlated investment to the stock market. When you're younger, you would like to be, for those who are a little more technical, highly correlated. Being highly correlated is smart. In fact, I would tell younger people they don't need to, for their retirement savings, they shouldn't own any bonds. They should have straight equities. It should be the index, a little international, and leave it alone. Highly correlated, that's okay. That's going to drive the greatest real returns during the accumulation phase. But in retirement, we have to have some investments that are negatively correlated to the stock market, meaning performing differently than the stock market would perform. And historically, when people discuss diversification like this, negative correlation, they would say it would mute your returns. But actually, that in retirement, during the distribution phase, when you're forced to take R&Ds and take income to live out of your savings, you aren't muting your returns. You're actually going to drive the greatest real return because markets go up and markets go down. And when markets go down, we have to have a place to withdraw our money from to avoid that sequence of returns risk we talked about. Paul, I know this is important to you. I might be stealing your thunder, but the most important part of a retirement is really that first 5 to 10 years, depending on how young you're retiring. If you're retiring younger, it's 10 years. If you're retiring a little older, it's 5 years. Those are the most critical years. If we have a negative market event, a big market event early, this is why they are forcing you to live on 3 or 4%, because they are not addressing this risk by properly doing asset allocation based upon spending planned and having negatively correlated investments. Paul.
And for those of you who are listening, who are sitting there thinking to yourself, well, I have cash and I'm going to use my cash as a pivot account. And sometimes, Kirk, we hear this, right? Sometimes we hear it. Besides the obvious,
Losing money slowly.
I was going to say, besides the obvious that you're losing money slowly, I will say this, and you may not believe this. If you're sitting around using cash as a pivot account, and your kids all of a sudden need a new car, or they have an emergency, or your grandchildren want something that you want to buy them, or all of a sudden you find this really cool thing you want to get, and you have cash sitting around, it is so easy to spend it, right? So sometimes we actually need to protect ourselves against ourselves. Cash, having a lot of cash as a pivot account is not a good idea.
It's insane, Paul. People with high savings accounts, just those high savings accounts isn't going to be there for a year, 5 years, 10 years, 20 years. It's going to be 30 years of your retirement. If you just use the rule of 72, double it again, and double it again. Literally, you got $200,000 sitting in cash. That's in 10 years, it'll be worth 400,000. And then in another 10 years, so total 20 years, it'd be worth 800,000. Then it's $1.6 million over your lifetime you've given up. That's insane. That is just anxiety, irrational fear. A pivot account, although to be fair, so I'm going to give some examples of pivot accounts, like laddered treasury bonds, a treasury bond that's going to mature over the next year, 2, and 3, 3-year ladder of treasury bonds. That's an example of a pivot account. A CD could be a pivot account, although I don't think it's the right use. I don't think the CD is the optimal pivot accounts. There's better. You guys might be surprised. I'm going to say this, I say this with much hesitation. A certain type of short-term fixed annuity could be a pivot account. But I'm just going to caution you. You got to be careful, because there's a lot of insurance salespeople selling a lot of annuities. It's a tool, and it should be only used for a short period of time as a pivot account, because we know we're going to have 6 to 8 major market events through a 30-year retirement. They're going to happen whether you like it or not. We don't know when it's going to happen. And when we have 6 to 8 major market events, a sustained market event, you have to have a pivot account to buy your investment accounts time to recover. Because again, we can't touch those investment accounts until they recover, or we're locking in the losses, causing sequence of returns risk. That's why the pivot account is so important. That pivot account is what's going to drive real return. The greatest performance, it's what's going to allow you to take the 7, 8, 9% withdrawal rates if you want them. It is the secret to the retirement plan. So we teach this in the class. We teach you what a plan looks like. We teach you how to ask the right questions to see if people are providing this for you. It's why it's 8 hours. It's master's level content taught at major universities. If you'd like to register, we ask for a $29 donation to charity. Go to retirementplanningedu.org. That's retirementplanningedu.org.
Thanks for listening to the Retirement Education Hour. Be sure to follow or subscribe when listening on Spotify, Apple Podcasts, or wherever you listen to your podcasts. And now back to the show.
Talking about asset allocation on the show today, and it gets thrown around as kind of this afterthought. What we heard from Kirk and Paul today is that what you're hearing from the financial services industry is doing you a disservice, actually. That this is a critical component to your retirement that gets overlooked, and it can mean the difference between a successful and an unsuccessful retirement. And I know you both of you bring this back all the time to planning, but asset allocation is part of that plan, isn't it?
Megan, here's the deal. You nailed it. Without a true comprehensive plan, I'm not talking about eMoney, Money Guide Pro, right? Any of the softwares that generate a probability of success report. Without a truly comprehensive plan, there is no way to properly asset allocate. And what is a result, you end up with general rules of thumb, default rules of what asset allocation should be. And that's crazy. Your investment shouldn't be a 60-40 portfolio. You may have a 60-40 portfolio as one of your accounts in your retirement plan, but there is no way to asset allocate without knowing when dollars are being spent from different accounts and then having different portfolios for different market conditions to take your investment, your income from. This is nuanced. I know our industry wants to simplify this and not overwhelm you. I get it. The reason they do that is because you all don't respond well to things that you don't fully understand. It causes anxiety. It causes you to shut down. It causes you to do nothing. As a result, you end up taking the simple solutions, people that give you simple, clear answers and then sell you simple products and investments because you can conceptually, you believe you understand those. And that's why you get sold those. The goal of the charity, and we are a charity, that is, I hope everyone understands that listens to us. We're a national charity. We are literally giving you 8 hours. And all we're doing is giving you the tools, the courage, the knowledge, the information to be able to make the right decisions in hiring the right people to help. You need people, you need a team to help you as you age, period. You're going to have somebody. And I don't want you buying products or investments. I want someone to build you a truly comprehensive plan. And that plan is going to tell you when you're taking income from different accounts at different ages. It's going to risk mitigate against an early spousal deaths. It's going to risk mitigate against all taxes, trying to reduce your lifetime tax bill for when you're both alive versus when one of you are alive. There are so many scenarios that have to be iterated and ran. You are overmatched when you go look for a team to help you without this information. This information gives you the power to say, no, that person's full of blank, or that person is really comprehensively risk mitigating, optimizing, and building me a plan, Paul.
I want to clarify something. As I'm listening to you and I'm thinking about this show, I think it's important to clarify that we're talking about asset allocation, but asset allocation is not an account.
Correct.
It's a process, right? You don't just it's not a one-time thing. One time we asset allocate and we're done. Asset allocation is a process that needs to occur throughout your retirement. It's not a one and done thing. It's not like you set up an account, you do a 60-40, you set up some type of an account and you close your eyes and you're done. Every year, those pivot accounts need to be established at the right time. This is a process. This is an approach. It's not an account. So if you're listening and you're looking at your retirement plan, if you want to know whether you have a true retirement plan or not, it's not something that's static. It's not something you can just see on a piece of paper, right? This is not a static approach. It's a dynamic approach. It's something that has to happen every single year.
Let me give them paint a picture. So think of every account you have, every registration, IRA, non-IRAs, emergency accounts, 401k, all your different accounts, all your different registrations for both you and your spouse. Each of the registrations have 3 separately managed accounts. We call them red, yellow, green zones, depending on when you're spending those dollars. And then you have to have a pivot account for those registrations. You're talking many accounts that are being asset allocated, driven by what do you need to give you what you want and when do you want it in retirement. That's what's going to drive your asset allocation, not a rule of thumb. So again, please attend. These courses will change your retirement. We guarantee it will change your retirement. If you would just attend 8-hour master's level, we teach them in person, 2 evenings or 1 full Saturday. We also stream them live from the universities. They're taught at major universities all over the country now. All we ask is a $29 donation to charity. If you'd like to attend, go to retirementplanningedu.org. That's retirementplanningedu.org.
Retirement Education Foundation is a fiscally sponsored program of United Charitable, a registered 501c3 public charity. Investing involves risk, including the potential loss of principal. This radio show is intended for informational purposes only It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Retirement Education Foundation is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Retirement Education Foundation is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Retirement Education Foundation. This radio show is paid for by the Retirement Education Foundation, a charitable program.